Hey guys, and welcome back. Now we've got one of the panels which I know everyone's been dying to see, and we've got some really great people who aren't short of sharing an opinion or two. So I know that we can hand over to Mr. Adam Conn to feed across to our equities panel on market structure. Adam, over to you, sir.
Okay, thanks very much indeed, and good afternoon to everyone. We've got an interesting panel for you. We've got some good questions, and the secret of this is really interaction. So we would be very keen for you to, when we put up some polls, to respond. And similarly, if there's any Q&A that you'd like to ask ahead of time, rather than just go through my list and our scheduled list, please feel free to try and stitch up the participants and ask them anything you'd like to ask. What I'd like to do first of all, though, is to start by asking each of our panelists to introduce themselves. We've got two Simons, so we've agreed that Simon Dove will become Dovey. And one of his claims to fame most recently is that he is rumoured to be replacing Richard Seamark in the Trade magazine's Hot 100. So if I could ask Dovey to introduce himself, that would be fantastic.
Goodness me, thank you, Adam. Don't quite really know where to go with it, but anyway, good afternoon to you all. Simon Dove, many of you will know me from previous places. I am in a new seat in terms of joining Internet Europe, which I'm delighted to be part of the management team, already a stellar team. From my side of things, I've joined looking at our liquidity, looking at how we can enhance, provide, and I guess most importantly, innovate in the industry. Much of the ethos that I've sort of carried through my career at exchanges and prop market making was about sort of offering and building and innovating and giving choice in the market. So delighted to have touched down with, well, I guess one of the world's largest agency franchises in Internet.
So, Dovey, can I just ask you? I mean, do you? I should have asked this question, and I'll ask the others, please, to add it in as well. Do you see your firm as a liquidity provider?
It's a great question, actually. Thank you, Adam. No, from our perspective, we're more on the aggregator side. I mean, we're an enabler. We are the original fintech, so we bring together different parties. We have some fabulous relationships across the market making community and the prop, and also on the sell side, and subsequently our buy side relationships. So we're not a liquidity provider, but we are from a perspective where we're an aggregator, and as an agency broker, I think from an independency perspective, we're quite unique in what we offer, which is great. And one final point, I guess. There was an article out yesterday describing myself, and it says keeping things fluid, which I've already had a lot of grief for. So I'm showing that hand early before anyone else throws it at me. But I'll pass across to whoever else wants to speak.
Okay, Jerry, can we go next with you?
Sure. Good afternoon, everyone. Thanks for that interlude, Simon. So again, Jerry Avenall, co-head of sales for the cash markets at SIBO Europe. So we operate exchanges and MTFs in the UK and in Holland. We also operate APA, both in UK and Holland, so we're the largest trade reporting venue for OTC and SI, and we also provide SI quoting facilities for most of the participants in the market. With regards to the second part of your question, we too also see ourselves as an enabler of liquidity provision. So generally speaking, exchanges in our view are all about enabling the community to come together and trade, but in our case, very much about innovation. So it's not just about lit books and closing auctions, to be clear. So we take a lot of pride in the innovations that we created over the last 13, 14 years, and we continue to keep doing that. So very, very keen to talk about what we're up to next as the year unfolds.
Lovely. I mean, we'll head to Letitia, if we may.
Yeah, so I've been a market structure practitioner for the last 15 years or so. Been with Barclays for 11 years, where I've been dealing with most of the regulatory change and liquidity change which were thrown at us over the years. To answer to your question, are we a liquidity provider? We're a systematic internalizer, so clearly we are. We will be providing access to liquidity to our clients, not only the one on venue and from a market maker side, but also providing liquidity out of our own risk trading. So
Okay, that's a great start. Thank you. And certainly not last but not least, well, actually, I'm last but not least. Mr. Gallagher, over to you, sir.
Thank you, Adam. So great to be here. So Simon Gallagher, I'm head of the cash and derivative markets at Euronext, which now operates 7 of the primary markets in Europe, with the most recent addition of our Italian colleagues. And to answer the question, it'll be similar to the first two. We see ourselves very much as an enabler of liquidity in 2 respects. So first, in the way we design the interaction with the liquidity providers who have contractual arrangements with us on the platform. And secondly, in the more general sense of enabling in a fair and orderly way an interaction with a deep and diverse pool of liquidity across the continent. So very much an enabler. We don't commit capital, of course.
Okay, thanks very much. So just to introduce myself, Adam Conn, Head of Trading at Baillie Gifford up in Edinburgh. In a prior life, I was the co-chair of the Fixed Buy-Side Committee, and and also a former chair of the Investment Association's Buy-Side Trading Committee. So looking forward to a good conversation liquidity-wise and hear what people are up to. And I will start just in another unoriginal fashion, just with a first polling question about the top priority for upcoming MiFID reviews. If people could respond to that as we're chatting, that would be great. We are talking about managing liquidity and sort of a couple of questions to go with. And firstly, what do you see, if I can go through each of you, if that's all right to start with, which do you see as the biggest liquidity challenges and how are you planning to address them? It's a wide question. Please feel free to share innovation, and we'll see what time's left at the end. So, Jerry, do you want to start?
Sure. Well, I think first and foremost, regulation is pretty much front and centre. We're in a bit of a state of flux. You've got MiFID 2 review coming shortly after MiFID 2 is implemented. It's been pretty contentious. I think there are a lot of opinions, but generally speaking, our view is that regulation has been pretty positive. It has presented a post-trade tape which is better than the one we had before. It has introduced some contentious elements that we think need reviewing, particularly the double volume caps. They need to be addressed. We don't think that they are good for the market. We don't think that they've contributed positively. And of course, with regulatory divergence, we may start to see, and in fact, we are already seeing the FCA diverge from the opinions of ESMA, specifically on double volume caps, which have now completely disappeared as of June, the reduction of LIS thresholds for EU securities in European names down to 15,000 euros, and of course their views on periodic auctions and their contributions to the broader liquidity landscape are well documented. So divergence is going to cause some issues. I think that presents an opportunity for ESMA to respond in a positive way. And then other things which I think are unintended consequences in part of MiFID 2. So concentration of liquidity in the closing auctions has partly been driven by the removal of broker crossing networks. Other mechanisms that were previously there that we used to cross up business have now resulted in a concentration of business in a single 5-minute period of the day. Is that a good thing or not? I think something that we could touch on. It would value the opinions of yourself and the banks. But it's a complex landscape. It's continuing to move around, and I think that's going to continue to create challenges for us as we move forward.
No, that's fair. I think one of the things I wanted to say actually at the beginning for myself is that we very much regard ourselves as a liquidity provider as well, and hopefully the sort of liquidity provider that is a trusted source with no onward leakage. So it'd be very interesting as we start to talk about the close, other liquidity capture formation tools and so forth. Can I maybe good time to pass on to my fellow liquidity provider, Letitia?
Yeah, I agree with most of what Jerry just said. I think regulatory speaking, there were quite a few challenges to work your way around new liquidity modalities. So MiFID had triggered the creation of the periodic auction. It may have been the impulsion, but now when you look at the data, you actually realize that periodic auction have an existence on their own. Jerry was referring to the fact that in the UK, we have no caps left. If you look at Europe, you have very few stock caps currently because the level of dark is actually not that high. So, and still we're seeing a growth of the periodic auction market share on the type of liquidity we can access. Even so, it's still small. Huh? We're still talking about a couple of percent. We're still below the 10%, way below the 10% for periodics. Your question in terms of what are the next challenge for accessing liquidity, I'm not going to go back to a kid's book, but it's a little bit where's Wally? You know, you need to find where the liquidity is. It's more complicated because you have more model, you have more diverse liquidity pools. So from a brokerage point of view, it sometimes has its challenge in terms of how you're going to work the order to try to get as much benefit as you can from the different pool of liquidity you can access, whether on venue or off exchange. And I think that's where most of those challenges are going to be. The regulatory element is not to be dismissed because we had our concern with the STO in the run-up to Brexit. The divergence or the possible divergence that we may have between the UK and Europe, we need to make sure we don't have unintended consequences on the back of it. From our point of view, our opinion, and which is mostly the opinion of our clients, and we spend a lot of time discussing those questions, is no one wants change for the sake of change. We're just out of 5 years of grueling regulatory agenda. I think people want to make sure that we're addressing the problem when they're being identified. And I'm not sure we are at a stage where there are huge problems to be addressed in the way stocks are being traded in Europe. There are problems to be addressed in terms of the readability of the tape. The tape has made some progress with MiFID, but has come with its own set of issues and difficulty to understand what's going on.
Yeah, it's interesting. Just in our first poll, that the consolidated tape is by far the clear leader. We do have one person wanting to protect the rights of private investors, and good luck to them. In terms of the rest of us who perhaps are representing the retail investor, Europe savers, from my perspective, it's a very clear choice. We want exactly the word I used. We want choice. It's not about one, mandating one form of trading or another. It's actually having the choice and the innovation of trading, and seeing what is available, what suits us, what is best for our clients, where are we going to get the best results. So interesting conversation, which we'll carry on. I'm anxious not to avoid a Where's Wally reference, but can I bring in Simon at this point? Simon Gallagher, just to introduce your perspective.
Yeah, sure. I think there's also a macro element to this, which needs to be addressed as well. So Europe is still, 20 years after, the first single market moves in this space, an extremely fragmented and complex space to navigate, especially for international investors. So when we talk about fragmentation, it's, if you take blue chip stocks, they're actually not that fragmented. You have the primary and then, 2 or 3 other markets. Is when you ask international investors to look at Europe and they see God knows how many regional markets. We still have 27 different CSDs with omnibus accounts and individual accounts, and this spaghetti of European infrastructure, which was really at the heart of the vision of the first MiFID and so on, I think has really been lost. So this question of Europe's vision for its market infrastructure is a key component to this liquidity question, especially for international flows. We think on SMEs as well, it's often an underexplored area in terms of liquidity. We're trying to work on a few innovative options there. There's been a lot of innovation in the blue chip space, which is great, but maybe there's some more can be done in the SME space. And finally, as we see ourselves as an enabler of liquidity. And so in this new sort of algo quantitative driven world, the challenge for enablers is to speak a quantitative language between the liquidity providers we're hosting on our market and the consumers of that liquidity in terms of the smart order routers and yourself, the end customer. So this is a really interesting time, I think, for exchanges. The language of liquidity is expressed in numbers, and we're all learning, especially exchanges, what this new language means.
Yeah, you mentioned there about the plumbing, and it's often been highlighted as the reason why ETFs don't trade on exchange as they do in the US. Is that something you're looking to address? Do you think that by creating more liquidity in the ETF space on exchange, that actually that will boost overall market liquidity?
I think it's a real shame that MiFID II didn't address the sort of on-screen aspects of trying to get more liquidity on exchange for ETFs. But if you look at the market structure of ETFs, and you know better than myself, it's a highly disintermediated and probably a very efficient way of trading ETFs, where you have direct buy-side access. TradeWeb and Bloomberg, they account for 60-odd% of the flows. Then you have all the regulated markets accounting for the rest with the sort of the on-screen model. So, I think in the next round of MiFID, I don't want to talk about MiFID III, Leticia, but there's maybe some more work to be done there on ETFs to see where this balance between on-market liquidity and the sort of more, which is a highly efficient way to trade, by the way, the sort of more TradeWeb Bloomberg vision is. So I definitely think there's a bit more that can be done on the regulatory side there, and it's a shame that MiFID II didn't address that.
Yeah, we obviously had the AFME put out a paper which was interesting, going back to a point Leticia made, that actually the levels of off-market trading aren't as high as was said. I mean, say kudos to FESI, who managed to get a response to a 32-page document out in 2 hours, which was a hell of an achievement. But where do you stand? I mean, do you agree with Leticia's point of view that that actually a lot of the numbers, a lot of the ESMA data, maybe which to their own admission is out of date, or maybe double counted, maybe not out of date, but double counted? Do you think it's a bigger problem as some people are suggesting?
I'll be very frank, right? So I saw this question come out, and it was so depressing. So it's 2021, and we're still talking about the same stuff that forced the LSE out in 2009 from FESE, and we're all sick of this debate. So obviously there's lobbying going on, it's between AFME and FESE, and that gets involved in a bit of this. But the core of the research, so we have a huge amount of respect for Auxera. These are very independent consultants. We've used them, the commissioners use them. And so I think a useful starting point now, like, nobody wants to go down this stupid debate. Like, we're beyond that now. We're personally, I think we all agree that, but the Auxera was very clear, and you can take and pick and choose what you want from the different filters they applied. So, why don't we just get around the table and we start with, the very first core of what they did, and then the different filters, price forming, non-price forming, and then you can have a debate about the detail. And I think that's a far more constructive way to progress this issue, which I think we have to, because we can't get caught up in this debate, which is 15 years old, and we need to move on.
So
okay, love it. Go on, Jerry.
I wouldn't mind interjecting here a little bit, because 75% of the OTC take goes through our APA mechanism. So the first observation is, to be impartial, I think neither party's right. And the reason I say that is that both parties sourced the data from big XYT, and you came to fundamentally different conclusions. So neither party can be either both right and wrong. That's the first point. The second point is that our view arguably should lean towards the FESI side of the view of the paper. That there's all this SI data commercially on a pure commercial basis. Of course, it would be interesting. It would be preferable for us that SIs didn't exist, that everything was on exchanges. But the practical realities are that the market needs many mechanisms to operate. BCNs were banned, SIs replaced them. Midpoint is a hotly debated topic, and there is a lot of acknowledged misreporting for legal reasons or interpretation of reporting, not deliberate by banks. And I'm sure we'll get onto this in a little bit more detail. But the general conclusion when we look at the data is that a lot of the conclusions that the exchange side of the paper would suggest that there is more addressable liquidity going on off exchange than is going on exchange. So our view would be that yes, there is of course addressable liquidity. Is it excessive? No, it's not. Does the data need to be cleaned up? Yes, it does. Are there things happening to address that? Yes, there are, and FICs are very much in the middle of that. So to some degree, Simon, I 100% agree with you. We should just move on. We don't want to get involved between AFME and FESI. They're two trade bodies which we're not represented on. But I think we should all agree that the best way forward is to address the problem, and that does lie on the regulators to help here, because the banks are in a difficult predicament. And I'm sure Letitia can explain why, but this comes down to legal interpretation of data and how it's been interpreted differently. So if we can fix that problem, then the debate just goes away.
Okay, Letitia, can we bring you in at that point just to respond to that?
I was about to intervene. I think, Simon, you're missing the key points of the Oxera report. I think the Oxera report was extremely honest about the limitation of the analysis. And a lot of the paper is actually delving in detail that no one wants us to go through right now, but dive into what is effectively the main problem of interpreting the data. In MiFID and the way the post-trade flagging works, we do have transactions that are of completely different nature. I liked very much Oxera reference to transaction with a genuine economic interest, so which makes us walk away from the concept of addressable, accessible type of liquidity. And the fact is, when you look at the tape, if you take the transaction not contributing to the price formation, you do have part of those transactions that, yes, are not dependent on the current price of the market, but hold some information that is valuable for the market to know. It's interesting for the market to know that you have people trading a guaranteed VWAP, that you have people trading portfolio trades. It's interesting, but it is not a liquidity that you can easily shift in any shape or form to a venue. And I think the Oxera report was particularly honest in saying, when we look at how the regulation is crafted and how we're supposed to flag trade, we do realize that the same heading is going to cover things that fundamentally are different in nature. I think we need to be prudent as well. I would disagree to say we need to walk away from the debate on the quality of the data and what the data says. I think we need to be much more honest in terms of segregating the data. Another point that Oxera makes is when you look at most of the trading activity from SI, among the 20 most traded stocks under the SI regime in Europe, you have a number of stocks which are British, American, Japanese, or Swiss. So if you take after a 10,000 miles view of the actual equities market structure analytics, and you say, oh my word, there is so much OTC and SI, if you don't start to look at the data in a little bit more granular fashion, it doesn't work anymore, and you can draw the conclusion you want. So that's why for us, the need of getting an agreement on how we're flagging things, which yes, may fall into some of the exemption of MiFID, but are not the same in nature, is super important. And we need to absolutely have a look at how the interpretation issue of the post-trade transparency can be addressed. Jerry, you were mentioning the fact that in banks, we are very often tied up by a legal interpretation. Some of the workflow that banks are executing are not straightforward to put in the right box. And you will have a tendency, not just us, but in the market in general, to go to the most conservative interpretation, which often leads to report something that maybe you could have not reported or flagged or a different way. The double reporting, the logic in MiFID to say the SI reports if you have a transaction between an SI and an investment firm holds its own issues. You have no easy way to know if the counterparty you're trading with is an SI in the name. And when you have two SIs, you need to know whether or not you're both an SI in the name. So you will have a double reporting here. And if we don't work on cleaning the data, I agree with you, Simon. We're going to continue to discuss this for the next 10 years. So for me, it's clear that having and fixed protocol is a great setup to do this, because that's the only trade association where everybody has a seat at the table. And again, I've said this several times, people need to get involved and people need to give their take on what they think the data should look like, aside from any advocacy position.
Yeah, I'm getting quite excited because it sounds like we're actually all agreeing in a direction of travel on how we can make things better, and no better time to bring in Dovey.
Thank you, Adam. It's fascinating where that question started and where we led. I think unanimously it seems like standardisation is and a mutual understanding and sitting around a table talking about something seems to be a sensible approach. And it's fantastic to hear the kind of detail and the view Letitia has. But I guess going back to your question at the start, Adam, which is broadly kind of the panel view is, liquidity, where are we, where are our challenges? And actually it links in kind of in the scenarios we talked about now, the issues with identifying liquidity, the issues with bringing sort of a granular or a view together that people that, like yourself, Adam, who are making decisions, have enough data in front of them to actually make an informed decision. And, we all have a part to play in that. We as a business have some fabulous tools with Indigo, which sits within our Newport system that allows people to have real-time analytics around that. Now, that gives a view on liquidity, and liquidity shifted and changed, not just because of Brexit, by the way. We've seen a transition end of last year into this year from some of the ELPs, SIs, and the types of prices that they're making. We've seen a shift of liquidity between venues with Brexit, with EU and UK venues. Brexit for me is the outcome, which is being discussed quite broadly, and maybe too early to call. But at the moment, Brexit to me really means I'm paying Jerry more money than I was before, which is not ideal. You kind of want to say, actually, what is this going to fuel a level of innovation and choice? And I think that links in with the where are we now and what do we want? And I think what we want as providers in liquidity provision, we may be not a direct liquidity provider in terms of a market maker or a prop, but we certainly provide unique liquidity to our clients and out to the street. We then have to innovate with the tools that we have. So we do that based on what people's perceived intentions are. If Adam or anyone else wants a block, you can trade blocks in several different ways, and we have a conditional venue, same as many other places. But actually, the most important thing for me, and one of the things I'm most excited about sitting in my internet seat, is actually if you've got unique liquidity, that then becomes much more interesting and appealing, and that gives you an alternative. So I think the question on where's our biggest challenges. Our biggest challenges are, for years now, we've had competition. It's driven certain positive things. We've still got a number of challenges across Europe, the UK, Swiss. But actually, we're in a good spot as an innovation. And actually, how do we move that to the next stage? It's to say, actually, we bring something different to the table. And then that gives people additional choice and everyone's kind of used my word enabler. And that's exactly right, because we're sat here, we have to create liquidity, we have to create choice. And we provide the metrics and the data for people like Adam and his peers to decide where they trade and how they trade. It's not our job to dictate that. And thank goodness we've got people like Letitia and Jerry who are solving the issue of market data and reporting and God knows what else, which again, we need to sort of shake down and standardize.
Yeah, it also save you a lot of money, Davy, because you use ETRs, which gives you lots of settlement netting benefits and allows SIs to continue to operate. But I think innovation is the key. I can't believe he's gone there. Go on, Jerry. Innovation is key here, and we've always been a strong advocate of innovation. We recognise that most of our clients are also competitors in some shape or another. We operate a block venue. Obviously, all CRBs are, to all intensive purposes, block venues. Liquid Net run a block venue. Other exchanges run block venues. It's all about that innovation, and those innovations that survive will be the ones that people adopt. I think, Adam, you made an observation about whether the market's getting too complicated. I just think liquidity's moved around because regulation has forced it to, but those venues that are successful will be the ones that have provided a genuine service that the market want to use, whether it's the sell side or the buy side. So we're looking to launch directed IOIs at the beginning of July. That gives CRBs direct access to the buy-side dealer with tailored liquidity to groups of their customers. That is something that removes technology barriers, takes a lot of noise out of the workflows for buy-side. So if venues and enablers continue to innovate like that, then we're going to get to a better place. And then the data outputs are cleaned up. We continue to get a better and better model. So, you know, to Simon's point, let's try and drive those innovations forward rather than continuously debating whether midpoint is or isn't a good thing. Of course it is. Every industry on the planet, people want a fair price, and that generally tends to be negotiating somewhere between what somebody's prepared to buy or sell a good at. So, you know, I think that going back to the point of the MiFID II review, that there are things here that ESMA could fix, and the double volume caps for us is a really big one of those.
Simon, can I bring you back in, because I think you started the direction of this conversation in a very positive way, in the fact that let's move on, let's sit around the table, let's identify what executable liquidity is. What would you see as the next steps to be able to do that?
We know Auxera very well, for example. So we offered to sit, they talked us through the methodology, and Leticia, they were very explicit, and I respect the methodology hugely. But then there are questions of interpretation that need to be done. So we are more than happy to sit around a table with a group of, we were trying to work out what's the best way to move on from this. So I think the best way is outside of lobbying associations. Not quite sure what it'd be. Maybe in FIX, I think something like that. And maybe it could be, I don't want to create work for Auxera, but going through and just understanding each other. Because I think exchanges are not investment banks, and investment banks are not exchanges. And I think there's still this residual, sometimes this misunderstanding and suspicions and so on. We know there are double counting, and we know, so just understanding each other a bit better in a neutral environment. Just like-minded people getting around the table with outside of the politics, I think would be a useful next step.
Great. So you fix potentially becoming the United Nations of the trading world, but it is the natural place. It is the place where it's not for profit. Everyone is represented. So some exciting things we can do there. One point I wanted to make on executable liquidity, and we have slightly gone off at a tangent, but it is to really stress the importance for those listening in of the value of accurate reporting, of knowing what really is trading in the market. In the US we have Reg M, which again, trade blocks don't get reported. In Japan, Toscanet, we don't see half the blocks printing, and really to understand it's not just about the point of trade, it's also about systemic risk in the market. And this is something which frustrates me, that doesn't get the attention that it deserves. When we are running our liquidity models, when we're running our capacity models, when we're making sure that we can return assets to clients in an orderly fashion, just like every other asset manager, we are relying on our proprietary tools, but we're also relying on quality data to be able to do that. It is absolutely essential that this gets resolved sooner rather than later. So in every market, let's start in the markets where we can influence. Let's start across Europe, UK, and get the flags correct. Understand what actually could be traded. Avoid these petty arguments about it should be traded this way or that way, but actually address the bigger problem. The first bigger problem is the fact, remembering what exchanges are for and what capital markets are for. And capital markets, in my opinion, are there to create capital formation and fund economic growth. If we start with that model, and that's our efficient approach to funding the right businesses, let's make sure that we can do so in a manner which does not create systemic risk. It's absolutely essential that we do this, and I'm just banging my drum on that front. So I'd be very happy to be part of those conversations as and when they take part. But let's move on to exciting things. We've talked about a little bit about innovation, but I suspect that there's probably more to come. So, Letitia, from your perspective, is there anything that you would like to share with us?
In terms of innovation?
In terms of innovation, or in terms of anything else you want to say?
Yeah, I would first say I completely agree with what you just said. One of the key point of getting the data right is to know exactly what is the liquidity you can access to offload your portfolio. So if you work on the basis of numbers that are inflated by 10, 20, 30% when you need to liquidate a portfolio, that is potentially a problem in terms of your calibrating your risk appetite and calibrating how much you think you can trade. So I would completely agree with this. The tape has some influence in the way you're going to calibrate the algos, but for us as a broker, I think things around innovation is going to be much more around how do you flex much more the way you're processing client orders. So what we've seen with COVID, with Brexit, with a number of market events is nothing is linear. So you're going to have different type of stocks, different type of markets who all operate in different ways. And we've seen recently some market events when you can have let's say social media and some of the buzz you can have on the internet actually starting to impact directly the way the market operates. So I think for the investment community as a whole, there is a real question on how you're going to make your execution algorithm, your strategy algorithm nimble enough to not only pick up on quantitative measure, but also qualitative measure. And I remember before COVID, I was at a conference and I heard someone from the hedge fund community talking about how they were starting to integrate some form of artificial intelligence in terms of processing qualitative information. And for me, the next battle in terms of how you invest, it's going to basically grow in flexibility and in almost blurring the line on how you're managing a client order based on what's happening right now, because things can change very quickly. And I think we're not there yet as an industry to have integrated this kind of ability to react very quickly to a sharp change of direction.
Mm-hmm. And where can I ask where does your firm stand on sort of creating alternatives to the official close? Do you think that's a good idea that because it lowers your costs, or do you think it's a bad idea because it reduces access to liquidity?
Yeah. That's always the debate between direct and indirect cost. How much are you going to damage the price formation in the close if you start to fragment the close? Generally, we have a number of clients that are not particularly keen on the fragmentation of the close. It's kind of an anchor point. Now, Simon was, I think it's Simon who was, no, it was Jerry who was talking about the increase of the proportion of the closing auction. I think there is a subject here to look at how the prices form in the closing auction, how much of the flow actually contributes to the price formation. There's been an increase of trading in passive investment on ETF. You tend to have more and more people actually managing their position and their portfolio at the close, which explain also this growth of the proportion of trading being made in the close. But I don't think that we need regulatory intervention around the close right now, but I think it would be good to have more transparency and more visibility on how the prices form. And I know Euronext has been doing very good work in their bilateral interaction with their members in terms of showing how the price was stabilizing in an auction. But I think it's a missed opportunity to socialize this more widely.
Yeah.
No, thank you. I appreciate the time is marching on, and 45 minutes is absolutely flying by. If I could just ask you all just to have 1 minute, just with two questions. In terms, Jerry, you've partly answered it, but if there's one piece of innovation that you really want to push and take forward, please mention it. And also, changing the subject completely, but in terms of your interaction with the market authorities, whether it be the EU or the UK, what is the key thing that you're pushing for?
Sure, well, I did touch on it. Thanks, Adam. So for us, the innovations around block liquidity continue forward, we are definitely seeing over this COVID period, as people start to return to work as well, that block liquidity and finding it is absolutely critical to asset managers. One of the things that constantly comes up for debate is how meaningful IOIs are. Can they be trusted? There's too much noise out there. There tends to be potentially market movements on the back of IOIs. So we're launching something that bids have already launched in the States in July. That's, as I said, directed IOIs that allows the CRB or portfolio or high touch single stock traders to direct IOIs into that network of 300 or so asset managers, where if they are present on the blotter, they would get a pop-up which is explicitly from an individual firm.
I'm going to cut you there, but in 10 seconds, in terms of anything that you're lobbying for, anything that you want to share with us?
The double volume caps and the consolidated tape. We don't think that DVCs serve a purpose at the levels that they're set, and we are, as we've always been, big advocates of a consolidated tape. I
agree with you on both. Davi, over to you.
Thanks. Thanks, Adam. So from my perspective, I don't really need to sell much because it sells itself, which is fantastic. But as a agency broker, we've had our own venue, Block Match and Block Cross, which is our conditional venue. It's fantastic to hear that Jerry and others are innovating in that way. We actually welcome it. We've seen huge growth, particularly on the conditional participation for Block Cross and also Block Match. I mean, the great thing about our venue itself, which is kind of the ability to combine an RFQ with a streaming and a dart book, as well as execute blocks with chosen counterparties, so the kind of bilateral piece. So, I can't take credit for building such a fantastic venue, but I certainly will help it to become probably Europe's best.
Lovely. And in terms of something to push for?
Yeah, push for. I mean, for us, it's the same scenario. We need to lobby for transparent, well-regulated, balanced trade environments. Best X rules the roost. Regulation, governance, super important. So,
and a degree of choice.
Interesting time.
Perfect. Simon, over to you, sir.
Yep, very quickly. So I think one area of real innovation for exchanges is going to be on the value chain and the connectivity, and answering the simple question who your customer is. If you were an alien from outer space looking down on the infrastructure of exchanges, you would see a hub and spoke network. And this whole notion of membership, it's a real 19th century kind of notion. So I think in terms of a bit of legal innovation to be done, more indirect memberships, and really maximizing touch points amongst the customer base.
Lovely. And anything you'd be lobbying for, similar to everyone else?
Yeah, I don't want to be cheesy, but the health of our markets depends on the health of the European economies, right? And so in all this regulation, we have to look at Europe as a competitive center in a world stage, and that will ultimately grow the markets and the pie for everyone. So that's the core of our.
I think that's a very, very important point you raise, is that STOs, too much time spent on those. We really need to, if you're based in the US or you're based in Australia or anywhere outside the region, you can trade wherever you like. So to stop EU asset managers being able to trade in the UK, just to me, just seems an anathema, just seems daft. And similarly, any restriction the other way, which I don't think there is at the moment. But I think we need to get past sort of the petty border jealousies and actually just get on with creating an efficient market that funds economic growth. But I'm going to leave the final word to Letitia in terms of innovation and a lobby.
Innovation, I think I will side with Simon, so with Dovi, so I'm not repeating it all. In terms of advocacy, for us, it's very clear. It's post-trade quality, simplification, and preserving diversity and optionality. If there is one thing that life taught us, is diversity is always an upside. And I think it's valid for trading as well. And we need to make sure we're preserving this, so it works for the investor and it does attract foreign investment within the European economy.
Okay, that's great. Well, listen, we've run to our schedule. May I thank you all very much indeed. There's many topics we didn't get to discuss, such as resiliency and others, but I think we've had a good crack of the whip, and I hope we get the opportunity to do all this again very soon. Thanks for your time.
Thank you very much.
Thank you very much.
Thanks, Adam.
Thanks.
Cheers.
Hi guys, and thank you so much for that panel. I think it's one of the best equities market structure panels I've seen for a very long time. It was great to hear such good, clear views being articulated. And also, I think it was brilliant in terms of the reference, in terms of the work that FIX has done. I think it's critical. As was talked about, there is already papers out there on the equities consolidated tape looking at those flags and fields which have been worked together by the industry, so everyone coming around the table, that United Nations approach in terms of trying to deliver that. So if you want to get hold of that, it's available on our website, but also please just reach out to anyone of the FIX team and we can make sure that's available to you. But thank you so much, Adam, for that. That was awesome. We're going to take a brief break, try and grab a cup of tea and a coffee, keep us going. We've only got a few more hours left. And three critical panels, but next one up is going to be fragmentation in fixed income markets. See you soon. Thanks a lot.